All right, let's dive right into this explainer. Today, we're looking at a totally unique financial instrument that basically allows you to own a piece of the nation's infrastructure. Think about it. Every single time you drive down a highway and pay a toll, or, every time you flick on a light switch in your home, you are consuming infrastructure. But what if, instead of just paying for those services, you could actually earn an income from them? Today, we're breaking down the fascinating world of infrastructure investment trusts, or Invits as they're commonly known, to see exactly how they work, the kind of returns they offer, and of course, the unique risks they carry.
Here's our roadmap for today. We'll be covering Section 1, what are invite funds? Section 2, expected returns in invites. Section 3, risks in invite funds. Section 4, who should invest? And Section 5, our final verdict, and subscribe.
Section 1. What are Invit funds? Understanding the basics. So, simply put, instead of buying typical stocks or traditional bonds, your money gets pooled together to buy physical, revenue-generating assets. It's kind of like a mutual fund in how it's structured, but rather than buying shares of corporate companies, the trust acquires completed, fully operational infrastructure projects. We're talking about massive, real-world assets here. Power transmission lines, gas pipelines, toll roads, the whole shebang. Governed by CBI regulations that were introduced back in 2014, these trusts issue units to investors. And the best part? These units are listed and traded right on stock exchanges like the NSE and BSE, making them super accessible for regular investors.
Now, behind the scenes, there's a mandatory, SEBI-regulated 4-tier structure that keeps everything transparent and safe. First up, you have the sponsor. This is usually a big infrastructure developer, like NHAI or Power Grid, who actually sets up the trust and transfers their operational assets into it. Then we've got the trustee, a SEBI-registered entity that literally holds these assets in trust just to protect your interests as a unit holder. Next is the investment manager. Think of them as the strategist making the big calls on acquisitions and managing the overall portfolio. And finally, there's the project manager. These are the folks on the ground, rolling up their sleeves, responsible for the day-to-day operation and maintenance of that toll road or power grid. This strict separation of powers is completely designed to keep your investment secure and professionally managed.
Moving on to Section 2, expected returns in Invits, yields and distributions.
Okay, so let's get to the fun part, the upside. What kind of income can you actually expect? Well, Invits typically offer distribution yields ranging anywhere from 6% to 12%. And honestly, that is structurally higher than most traditional investment-grade bonds out there. To put that into perspective, as of 2026, AAA-rated PSU bonds might offer around 7 to 7.5%, and A corporate bonds sit around 8 to 9.5%. But Invits, they push that boundary higher, making them a genuinely interesting income instrument that sits comfortably right between equity and debt. Here's the real kicker. These trusts act like massive income-generating machines because they are legally forced to pass almost all their cash flow straight to you. Yep, according to SEBI regulations, an invite absolutely cannot retain more than 10% of its net distributable cash flows, or NDCF. A full 90% must be paid out to unit holders, and they usually do this on a quarterly or semi-annual basis. This mandatory distribution rule is absolutely crucial. It's the core engine that transforms these giant infrastructure projects into a steady stream of passive income for your portfolio.
Now, when you look at some specific yields, it becomes super clear that the returns directly reflect the underlying risk. Take the Power Grid Invit, for example. It yields around 6 to 7%. Why? Well, because it operates power transmission lines with highly predictable, tariff-based contracts that are backed by a government-owned Maharatna PSU. It's essentially the lowest risk option. But as you move over to something like the IRB Invit yielding 10 to 11%, you're dealing with toll roads. Toll roads are highly variable. They depend on daily traffic volumes, fuel prices, and are definitely subject to economic slowdowns. So a higher yield here doesn't just mean you found a better deal. It directly reflects the higher uncertainty in that cash flow.
Section 3. Risks in Invit funds. Understanding asset risk.
Now, we need a quick reality check because Invits are absolutely not risk-free bonds. Unlike a standard bond with a fixed coupon, Invit's revenue stability and asset life vary wildly, depending on whether you're holding a steady power transmission line or a highly variable, traffic-dependent toll road. With a power transmission Invit, your income is tied to 35-year licenses and regulated tariffs. The power grid guarantees 99% plus asset availability, which means the cash flow is almost as predictable as a traditional bond. However, a toll road is a totally different beast. Its revenue drops if a new alternate route opens up, if fuel prices spike, or if there's a broader economic slowdown that keeps trucks off the highway. Plus, toll roads operate on concessions that usually expire after 15 to 30 years.
And that variable asset life? Well, that builds into the biggest risk of all. Unlike bonds, which return your face value right at maturity, toll road concessions eventually expire. As a road gets closer to the end of its 15 or 30-year concession, the value of that specific asset steadily declines towards zero. What this means for you is that those high 10 or 11% quarterly distributions you're receiving might not actually be all profit. A significant portion of it could simply be a return of capital, meaning the Invit is basically just handing your own initial investment back to you as the asset depreciates. There is literally no capital guarantee here. Furthermore, Invit unit prices trade on the stock market, meaning they are very sensitive to interest rates. So if the central bank raises rates, the price of your Invit units will likely fall.
Section 4. Who should invest? Is it right for you? So with those risks in mind, how do you know if you are the right fit for this instrument? Well, if you check these boxes, especially if you already have a safe core fixed income portfolio, Invits could be a fantastic diversifier for your long-term wealth. To be clear, you definitely shouldn't park your emergency fund here. Invits are designed for investors who already have a baseline of safety through traditional fixed deposits or high-grade corporate bonds, but are looking to boost their overall portfolio yield into that 8 to 12% range. You absolutely need to have a minimum investment horizon of 3 to 5 years. And most importantly, you must be psychologically prepared for the fact that your quarterly payout amount will fluctuate and the underlying unit price on the stock exchange will move up and down just like a stock.
Section 5. Final verdict and subscribe. Let's wrap this up.
So let's bring all this together. Invits really represent a fascinating evolution for the Indian investor. They literally allow you to earn a yield every time someone pays a toll or turns on a light, provided, of course, that you understand the risks. They beautifully bridge the gap between the predictable but lower returns of standard debt and the volatile but higher growth potential of equity. By carefully choosing the right Invit, maybe you prioritize the stability of power transmission, or maybe you're willing to accept the volatility of toll roads for a higher payout. You can actually tailor your own passive income stream. But remember, you always have to look beneath the yield to understand the asset life and the true nature of the cash flow.
Thanks so much for joining me on this explainer today. Don't forget to like, share, and subscribe for more deep dives into the financial landscape. But before you go, I want to leave you with this thought. Next time you're stuck in traffic at a toll plaza, watching thousands of cars pass through, ask yourself, shouldn't your portfolio be collecting a fraction of every single transaction happening right in front of you?